What could the recent BRICS summit mean for global markets?
We've aggregated insights from top analysts like Michelle Makori and Dave Collum to keep you in the loop.
And the best part? You'll get key insights distilled into just a few minutes.
Exactly. Discover potential trends and how Bitcoin might react following these developments.
Welcome to Financial Insights in Minutes, where we deliver concise summaries from the financial world.
Stay tuned for analyses that might just change your investing game.
But first, let's hear from the Bravo's research team on surprising predictions from their latest insights. Anchors away on our next topic. Are we heading towards a soft landing or a crash landing?
Let's get straight to the facts. The term soft landing has been thrown around a lot lately, particularly with insights from 2007 ringing alarmingly similar.
It's fascinating how history tends to repeat itself. What do the numbers say? So, what's the crux of the discussion? Is this just historical déjà vu?
The core thesis argues that today's buzz around a soft landing could be misleading. We need to look at whether the job market's resilience is genuine or just a facade masking underlying issues.
Let's break down what a soft landing really is.
Essentially, it's when the Fed raises interest rates but manages to lower them back before a recession hits. But how often does this actually happen?
Now, looking back at history, what do we see?
It's eerily similar to the period leading up to the Great Financial Crisis. Back then, strong job numbers were reported just before the markets dipped.
Interesting. What's the state of the current job market?
While the job market appears strong, 254,000 new jobs in September, questions about data accuracy loom large as they did before previous recessions.
What about predictions moving forward?
Well, if credit remains tight, we might see ongoing economic challenges until mid-2025. However, if conditions loosen significantly, perhaps a soft landing could finally happen.
So, any insights on the job market specifically?
The next year could see unemployment rise if credit remains tight. If the economy doesn't tank and credit loosens up, we could dodge a recession? Maybe.
To wrap it up, where do we stand?
The situation is precarious. While a soft landing seems appealing, the balance of economic indicators paints a more concerning picture.
There's a lot to consider looking ahead.
Absolutely. It'll be intriguing to see how this plays out moving forward.
But hold on to your hats. Up next, we explore insights from Dave Collum on markets overvalued by 150% as dishonest metrics hide the coming catastrophic collapse.
Trust me, you won't want to miss what Dave Collum has to reveal.
Anchors away. Are markets overvalued by 150%?
Here's the scoop. Dave Collum argues that the metrics we rely on are skewed and dishonest.
Seems like a heavy tide ahead. What specifics is he bringing to the surface? So, what's Collum's main thesis here?
He insists that U.S. markets are at a peak and that real value has gone missing, indicating we're set for a catastrophic correction.
Let's navigate through the key points, starting with market overvaluation.
Absolutely. Collum points out that the current market has inflated dramatically beyond historical norms, about 150% overvalued based on historical averages.
And how about those economic metrics?
They're misleading. Collum argues that official CPI figures don't tell the full story, and inflation is likely much worse.
What about predictions for an economic collapse?
It's tumultuous. Collum anticipates a significant correction where the markets could suffer drastically, drawing painful comparisons with historical collapses.
Now for some predictions. What does Collum envision for the dollar?
He foresees the dollar collapsing as inflation continues to erode trust in the currency. When this starts, panic buying is inevitable.
And what about investor sentiment moving forward?
He argues that, after a significant correction, confidence in the markets might take a long time to repair, affecting future investments.
To wrap up, what are the crucial takeaways?
Collum emphasizes the need for cautious strategies to navigate potential market chaos, a tumultuous era ahead.
Any final thoughts on economic metrics?
Collum's call for transparency in data is paramount. Less deception in metrics allows for sharper insights.
But hold on to your hats. Up next, insights from Danielle DiMartino booth on 20% of U.S. on welfare, household bankruptcies surging.
You won't want to miss the revelations she has lined up.
Anchors away. We're diving into the alarming surge in welfare recipients.
Let's get straight to the facts. Danielle DiMartino booth reveals that over 70 million Americans are now living on welfare.
That's over twice the population of Canada. What's driving this crisis, and how's the economy faring? So what's the core issue here?
The crux of it, as Danielle points out, is that more people are relying on welfare as they face job loss and dwindling savings amidst a marked increase in bankruptcies.
Let's break down the figures. What do we see about welfare?
The numbers are staggering. We now see over 70 million on welfare, an astonishing rise of 22% just in the last year.
Now, what about bankruptcies? They must be telling a significant story.
Absolutely. We're witnessing the highest levels of corporate bankruptcies since 2010. Household bankruptcies are not far behind, surging by 22% compared to last year.
And what's the outlook for our job market?
The job market shows mixed signals. While there are new jobs, the growth is sluggish and more Americans are exhausting their unemployment benefits than ever before.
What does Danielle predict for the future?
The forecasts indicate that unless significant changes occur, we could see rising welfare dependency as a chronic issue, which may signal a recession looming ahead.
And how are the markets reacting?
Interestingly, investors seem numb to geopolitical tensions, focusing less on the news and more on U.S. market performance, despite the troubling indicators.
So what are the key takeaways?
Danielle stresses that to curb this cycle of dependency, the private sector needs to step up and provide better opportunities, or we'll keep seeing these issues escalate.
Hold on to your hats. Up next, we're exploring solutions and insights from the FX Evolution Channel team.
Trust me, you won't want to miss their take on the market's next big moves.
Anchors away. Our next insightful summary dives into the disappearing bearish sentiment in the markets.
Let's get straight to the facts. Recent sentiment surveys show bearish responses at an all-time low. What could be causing this turnaround?
It's time to navigate through these choppy waters. Are the bulls truly back in control? What's the core thesis driving the discussion here?
The latest data reveals that bears have retreated, leading to a bullish outlook. With central banks worldwide increasing liquidity, there's a positive vibe in the markets.
What bullish indicators are the experts pointing to?
Global liquidity is soaring, fueling optimism. As the S&P 500 tracks upwards, there's a growing confidence among traders.
What about the bear-bull spread? What's the story there?
As bearish sentiment dwindles, we're nearing the danger zone of a nearly 30% bullish margin. It urges a balanced approach.
And how does inflation fit into all this?
The consumer price index aligns with expectations, yet reflects sticky inflation risks, especially within the services sector.
What predictions are on the horizon?
Expect further bullish momentum, though some anticipate possible volatility in October without signaling a crash.
Could global events sway market dynamics?
Absolutely. Expect significant reactions in commodities like gold and oil due to geopolitical tensions.
Summing it all up, what should traders keep an eye on?
Though sentiment may seem bullish, remnants of volatility linger. Investing decisions should be made with caution.
But don't set sail just yet. Up next, we explore insights on potential volatility in the upcoming session.
You won't want to miss the analysis on what's coming next.
Anchors away on stocks being super expensive right now. Let's dive into the latest market insights.
Here's the scoop. Lance Roberts points out that stocks have shown remarkable returns recently, but are they really a bargain?
Time to navigate through these charts and data. So, what's the main thesis here? What should we keep an eye on?
Lance emphasizes that while the markets have soared, current valuations seem excessive, prompting a potential correction.
All right, let's unpack this record-breaking performance.
Absolutely, year-to-date returns are through the roof, surpassing notable historical benchmarks. Who can argue with such success?
What do those high valuations mean for investors?
Lance explains that although returns are stunning, valuations indicate risks of market corrections down the line.
What's the buzz around earnings season?
Expect volatility as major corporations report, potentially swinging stock prices. It's a pivotal moment.
What's Lance predicting regarding potential corrections?
He anticipates a market correction as earnings likely won't support current valuations.
What should investors take away from this?
Reassessing risk exposure is crucial as we approach changing market dynamics.
Wrapping things up, what are our key takeaways?
Lance highlights that while the market is growing, the signs suggest a cautious approach is warranted to manage potential risks.
But wait, there's more. Coming up next, insights from Stephen Bavaria at the Fall Online Conference.
This is an unmissable opportunity for key financial strategies you won't want to miss.
Anchors a way into our next insightful summary. Are repo fails revealing hidden troubles in the banking system?
Let's get straight to the facts. Jeff Snyder breaks down the recent repo fail data and its implications for economic stability.
That sounds like a tide of information. What's got the financial world buzzing? What's the main thesis here? What is the financial storm brewing?
Snyder suggests the surge in repo fails indicates worries over collateral scarcity and U.S. recession threats, especially tied to the yen-carry trade dynamics.
Let's break down these key points. Start with those repo fails.
Absolutely. The repo fails are a red flag, spiking to $400 billion. This surge is the highest seen since last year.
What's the deal with collateral?
Collateral scarcity is rising, surprising given the abundant treasury offerings. Increased demand for short-term treasuries shows there's trouble brewing.
Now let's navigate to the yen carry trade.
The yen carry trade is reversing, with many Japanese financial firms unwinding higher-risk assets due to increasing fears of a U.S. recession.
Looking into the crystal ball, what's in store for financial markets?
Markets may see continued volatility. If Japanese firms prioritize safety, we could witness substantial shifts in global asset allocations.
And what about the demand for treasuries?
Expect heightened demand for U.S. treasuries as participants prioritize liquidity and safety amidst market upheavals.
Summarizing our discussion, what are the big takeaways?
Understanding repo trends is vital. The implications of rising fails and collateral scarcity signal caution ahead.
Any final thoughts on financial practices?
Transparency in financial practices is crucial, especially as repo market dynamics unfold. Let's keep an eye on these developments.
If these insights have been valuable, don't forget to subscribe.
Your support keeps us delivering the crucial analysis you need for navigating these financial waters.
As we wrap up, it's clear that a consensus around economic uncertainty is shaping up.
Indeed, Jeff Snyder opened the discussion highlighting the creeping signs of recession, while Dave Collum placed a staggering valuation figure on it.
And that's wild. Lance Roberts also pointed out this overvaluation, but seemed more concerned about an imminent correction.
Yes, and Danielle DiMartino Booth's take on rising bankruptcies really underscores the urgency of these financial warnings.
So, as we navigate these tricky waters, what's the key takeaway for our viewers?
Be wary of these red flags and adjust your investment strategies accordingly.
Absolutely. Don't forget to like and subscribe to our channel for more in-depth insights and timely updates.
Leave a comment below on what you believe will happen next. Your insights matter to us.
Thanks for watching. Be sure to check out our other videos to keep your financial knowledge growing.